Right now, 3.1 million unsold cars are sitting on dealer lots, a 30% jump in just 1 year. Meanwhile, car loan interest rates have skyrocketed to 7.2% for new cars and 11.4% for used ones. Imagine a buyer walking away from their dream car because monthly payments are now out of reach. These numbers aren't just statistics, they're signals of a brewing crisis. In this video, I'll break down the data behind the looming automotive market crash. From post-pandemic price surges to predatory financing and new tariffs, I'll explain what's happening and why it matters. Stay tuned, this is critical information. The $1.7 trillion time bomb. Imagine owing $6,838 more on your car than it's actually worth. That's the average negative equity for millions of Americans right now, a staggering financial burden that's becoming increasingly common. Auto loan debt has ballooned to $1.7 trillion, a number so massive it surpasses the entire GDP of Russia. Why does this matter? Because it highlights just how deeply entrenched this issue is in the economy, affecting everyday Americans who are struggling to stay afloat. Nearly 1 in 4 trade-ins now come with over $10,000 in negative equity, according to Edmunds data. This means there's a 25% chance that if you trade in your car today, you'll still owe more than $10,000 on a vehicle you no longer even own. For many, this isn't just a statistic, it's a harsh reality. On Reddit, people are sharing their financial struggles, painting a vivid picture of what this crisis looks like in real life. One user wrote, "I owe $32,000 on a car worth $18,000. My payment is $689 per month for 72 months. I can't refinance because of the negative equity." Another shared, "Dealer rolled over $8,000 from my last loan. Now I'm paying $820 per month for a base model Civic." These stories show how quickly debt can spiral out of control, leaving people trapped in loans they can't escape. The average negative equity hit an all-time high of $6,838 in Q4 2024, up 42% from just 3 years ago, according to Experian data. This sharp increase is part of a dangerous cycle. When you trade in an underwater car, dealers often roll the remaining debt into your new loan. Suddenly, you're financing not just the new car, but also the leftover balance from the old one. This creates a snowball effect, where each new loan becomes harder to manage than the last. Refinancing used to offer a way out of this cycle, but that's no longer the case. With used car loan rates now averaging 11.4%, refinancing has become nearly impossible for most borrowers. Even those with excellent credit scores, 760 and above, are facing rates as high as 7.2% on new car loans. The system is designed to keep borrowers trapped. Once you're underwater, lenders know your options are limited. You either keep making payments or risk defaulting. This isn't just a personal finance issue, it's a systemic risk. When millions of people owe more on their cars than they're worth, the entire auto finance system becomes unstable. Repossessions have surged 38% year over year, according to Fitch ratings, and defaults are rising even among borrowers with prime credit. The auto loan crisis in 2025 is shaping up to be worse than anyone predicted, with ripple effects that could impact the broader economy. Pandemic's lasting scars. March 2020 marked the lowest point for auto production since World War II. The U.S. International Trade Commission reports production levels dropped to what we last saw in 1945. For weeks, drone footage revealed factory lots eerily empty, where thousands of vehicles should have been rolling off assembly lines. At least 93% of U.S. auto manufacturing ground to a halt during those early pandemic months. Plants began reopening by late April 2020, but production didn't recover overnight. According to the USIC, it wasn't until July that output returned to 2019 levels. The Bureau of Transportation data paints a stark picture. The U.S. produced over 2 million fewer vehicles in 2020 compared to the previous year. Domestic car sales mirrored this decline, underscoring the scale of the disruption. The initial shutdowns triggered a supply shock, akin to a sudden earthquake shaking the foundation of the industry. But the real challenge came when demand surged unexpectedly. Stimulus checks hit bank accounts while people were stuck at home, rethinking their transportation needs. Many opted to spend that money on cars, especially as public transportation felt increasingly risky. Meanwhile, semiconductor manufacturers pivoted to meet skyrocketing demand for electronics like laptops and gaming consoles, driven by the remote work and entertainment boom. This shift in focus created a bottleneck for automakers. Modern vehicles depend on semiconductors for everything from engine management to touchscreens, and the shortage quickly became a choke point. Trade restrictions with Chinese tech firms like Huawei added another layer of complexity. Some companies began hoarding chips, bracing for future shortages. The result was a perfect storm: low supply colliding with high demand, leaving automakers scrambling to adapt. By 2021, production numbers inched upward but never fully rebounded. Sales remained sluggish, as Ward's intelligence data shows. The OECD raised alarms about the fragility of global supply chains, warning that the pandemic's ripple effects were far from over. What began as temporary factory closures evolved into long-term production constraints, reshaping the industry's trajectory. Dealer lots, once brimming with options, became barren landscapes in 2021. Customers faced months-long waitlists for popular models, with delivery times stretching to unprecedented lengths. Manufacturers, constrained by limited production capacity, prioritized high-margin vehicles, leaving fewer affordable options on the market. The scarcity sparked fierce competition for available vehicles. Auction prices for used cars soared as rental companies and dealers scrambled to replenish their inventories. Wholesale used vehicle prices jumped 37% from 2019 to 2021, according to Manheim data. This surge rippled directly into retail prices, forcing consumers to pay significantly more. At the worst points, new car inventory levels dropped to under 30 days supply, less than half the traditional 60 to 70-day benchmark. This scarcity gave dealers unprecedented pricing power. MSRPs, once a ceiling, became a starting point. Customers often paid premiums just to secure any vehicle, let alone their preferred model or trim. The production gaps left a lasting mark on the industry. The USIC report highlights how the 2 million vehicle deficit created a hole automakers are still struggling to fill. Those missing cars represent billions in lost revenue and untapped consumer demand, a reminder of how deeply the pandemic reshaped the automotive landscape. The MSRP lie. 82% of buyers paid over sticker price last year. But here's what dealerships aren't telling you. The manufacturer's suggested retail price has become meaningless as dealers impose massive markups on nearly every vehicle. We've seen window stickers showing $5,000, $8,000, even $12,000 in market adjustments on common models like Honda Civics and Toyota RAV4S. Base model sedans with cloth seats and plastic steering wheels, not luxury vehicles. This markup system starts at auctions, where dealers acquire used inventory. Spiny.ai data shows that dealers typically add 10 to 35% to the wholesale price before putting cars on their lots. For example, a $15,000 auction car becomes $20,250 with a 35% markup. Trade-ins feed into this system as well. Dealers offer you wholesale value for your car, then mark it up 30% or more for the next buyer. The average trade-in age is just 3.6 years, according to Edmunds, meaning relatively new cars are cycled through this profit machine. Together, auction markups and trade-ins create a system where every step inflates prices for buyers. Consider this real case from Texas last month. A buyer paid $8,000 over MSRP for a base model 2024 Honda Civic LX. The sticker price was $24,845, but the dealer tacked on a $5,000 market adjustment, $1,200 for nitrogen tires, $800 for paint protection, and a $1,000 dealer fee. The final price? $31,845 before taxes. That same car would have sold for under $23,000 before the pandemic. The buyer told us, they said take it or leave it. 15 people were waiting if I walked away. This story isn't unique. It's a snapshot of how markups and mandatory add-ons have become the new normal. These add-ons are like a hidden fee tax, baked into the price before negotiations even begin. Dealers now require purchases like $400 floor mats, $700 security systems, or $1,500 extended warranties just to complete a sale. One dealership group in Florida was caught charging $2,495 for theft protection stickers that cost just $5 to produce. These aren't optional upgrades. They're mandatory charges disguised as extras. The numbers paint a clear picture. In December 2024, the average new vehicle transaction price hit $49,740, according to industry data. That's 1.3% higher than the previous year, even as inventory levels grew. Manufacturers offered average incentives of $3,500, or 7.2% off MSRP, but prices still climbed. Vehicles under $30,000 were hit hardest, with over 80% facing significant markups. The most vulnerable buyers, those shopping for affordable cars, are the ones paying the steepest price. Used cars follow a similar pattern. In December 2023, the average used vehicle listed for $25,128, while dealers typically paid $18,000 to $20,000 at auction for those same cars. The $2,500 average markup doesn't even include reconditioning fees or mandatory add-ons, which push profits even higher. Specialty vehicles see even more extreme markups. For instance, we found a used Ford Bronco priced $28,000 above its original MSRP. Dealers rely on sophisticated software like vAuto to track market demand in real time. If a car gets lots of online views, its price can increase that same day. One dealership manager admitted, "We change prices 3 times daily based on website traffic." This dynamic pricing creates artificial scarcity. Even when inventory builds up, prices remain high because the algorithms indicate they can be. This system creates perverse incentives. Dealers often prefer to send unsold cars to auction after 60 days, rather than significantly lowering prices. For example, a 2023 Honda Accord priced at $32,000 today might wholesale for $24,000 next month if it doesn't sell. But instead of discounting it by $3,000 now, dealers gamble on finding a buyer willing to overpay. Electric vehicles highlight the most extreme cases. In Q4 2024, the average negative equity on traded-in EVs hit $10,186, according to Edmunds. Why? During the shortage, dealers marked up EVs by $15,000 or more, and now their values are plummeting. A $65,000 Ford Mustang Mach-E that sold for $80,000 in 2022 might now be worth $38,000, but the buyer still owes $72,000. This leaves consumers trapped in a cycle of debt, unable to recover from inflated prices. Manufacturers, while publicly discouraging markups, are complicit in this system. Franchise agreements prevent them from directly controlling dealer pricing. Some brands, like Ford, have threatened to reduce allocations to dealers who engage in price gouging, but enforcement is inconsistent. Automakers also benefit indirectly. When dealers extract maximum profit, it makes the MSRP seem more reasonable by comparison. The looming threat of tariffs only adds fuel to the fire. With 25% tariffs on popular models like the Honda Civic and Toyota Corolla potentially on the horizon, dealers have another excuse to raise prices. One Honda sales manager admitted, "We're telling customers to buy now before the tariffs hit. But really, we're just using it to justify current markups." This system, from auction markups to mandatory add-ons, dynamic pricing, and artificial scarcity, ensures that buyers face inflated costs at every turn. Whether it's a base model sedan or a specialty vehicle, the deck is stacked against consumers, and the profits keep rolling in for dealers. Banks slam the brakes. 1 in 5 auto loan applications now gets rejected outright. Sarah from Ohio is a perfect example of how broken the system has become. She makes $75,000 annually with an 802 credit score. Her current car payment is $380 per month. She applied to refinance her $22,000 loan at a better rate. Denied. The reason? Excessive vehicle depreciation relative to loan balance. Translation. Her 2021 SUV is worth $18,000, but she owes $22,000. Despite her stellar credit, the bank wouldn't touch that $4,000 gap. Even buyers with excellent credit face brutal terms. A 760-plus credit score used to guarantee rates under 4%. Now those same borrowers get 7.2% on new cars and 9.5% on used. Bloomberg data shows denial rates surged 37% year over year as lenders tighten standards. It's no longer just about credit scores. Banks now scrutinize job history, debt-to-income ratios, and even social media profiles. One lender admitted they're running employment verification checks twice before funding loans. The rejection letters we've seen highlight reasons like excessive negative equity and payment-to-income ratio too high. One applicant with a 720 credit score was denied a $25,000 loan on a used Toyota Camry because the bank decided his $4,000 negative equity from his trade-in made the deal too risky. Lenders are also demanding ridiculous documentation. One credit union requires 10 to 20 personal references just to process an application. Others want 6 months of utility bills, 3 years of tax returns, and notarized letters from employers. A Chase Auto Loan officer told us, "We're treating every application like a mortgage now. If you can't prove you'll keep this job for 5 years, we're not approving you." The numbers tell a grim story. Subprime borrowers, those below 620 credit scores, face 60-day delinquency rates at 6.56%, the highest since 1994, according to Fitch Ratings. But here's the kicker: prime borrowers, 720 plus, now have delinquency rates triple what they were in 2019. Even people with great credit are struggling to make these inflated payments. Lenders are changing how they calculate risk, and it's killing deals before they even start. Many now assume every car will depreciate 25% in the first year instead of the traditional 15 to 20%. That means if you borrow $30,000, the bank assumes your car will only be worth $22,500 next year. If you try to trade it in, you'll automatically be underwater. Dealers are feeling the squeeze too. One Ford finance manager showed us their approval rate dashboard. Only 58% of applications get funded now versus 82% last year. "We're having to submit deals to 5 or 6 lenders before one bites," he said. And even then, they're charging dealers higher fees to take the paper. Those fees get passed to buyers as higher interest rates. The Federal Reserve cutting rates hasn't helped much. While the prime rate dropped slightly, auto loan rates stayed stubbornly high. Lenders are building in extra risk premiums. That 7.2% average new car rate includes about 1.5% pure profit margin for banks, double what it was pre-pandemic. Leasing has become nearly impossible for average buyers. Banks now require 740-plus scores for leases, and even then, they're limiting terms to 24 to 36 months instead of the traditional 48. Money factors, the lease equivalent of interest rates, have doubled since 2022. A $399 per month lease on a BMW 3 Series now costs $599 with $3,000 more down. Credit unions, traditionally the last refuge for decent rates, have become just as strict. Navy Federal now caps auto loans at 125% of book value, meaning if your car is worth $20,000, the max they'll lend is $25,000. That kills deals where buyers have negative equity to roll over. One member reported, "They wouldn't even let me apply once they heard I had a trade-in with $5,000 negative equity." The ripple effects are brutal. Dealers report 30% of approved buyers now back out when they see the final terms. One customer was approved for a $35,000 loan at 14.9% interest for 84 months. His payment would have been $652 per month for 7 years on a car that'll be worthless in 5. He walked. Banks are quietly exiting the subprime market altogether. Capital One and Wells Fargo have stopped financing deep subprime, below 550 score, loans entirely. Santander now requires 20% down payments on all used cars over 60,000 miles. These moves lock millions of working-class buyers out of the market completely. The most shocking denials come from buyers with perfect payment histories. We reviewed a case where a nurse with 12 years of on-time payments got denied to refinance her $18,000 balance. Why? Because the bank decided her 2019 Honda Accord had excessive mileage risk at 68,000 miles. Never mind that she'd never missed a payment in her life. The approval process has become a marathon of paperwork. One buyer shared his 23-day odyssey trying to get a $28,000 loan approved. First, the bank wanted proof his freelance income was stable, 6 months of client contracts. Then they demanded his landlord verify his rent payments. Finally, they insisted on a mechanic's inspection of the used car, at his expense. The loan still got denied. President Trump's tariff threats make lenders even more nervous. One major bank's internal memo warned loan officers, Anticipate 15 to 25% vehicle price increases if new tariffs take effect. Adjust loan-to-value ratios accordingly. Translation: they'll require bigger down payments to offset the risk of cars becoming even more overpriced. The system is broken, and the risks are clear. Higher interest rates, stricter terms, and endless documentation are locking out even the most qualified buyers. For many, the dream of owning a car is slipping further out of reach. $1,000 monthly nightmares. The average new car payment just hit $760, but that number hides a deeper issue. Some buyers are signing up for $1,200 monthly payments on basic vehicles like Honda Civics and Toyota Corollas. One buyer in Florida is paying $1,347 per month for 84 months on a $42,000 pickup truck, more than many people pay for rent. These extended loans are like a slow-burn debt trap, luring buyers with lower monthly payments while burying them in long-term financial strain. Nearly 70% of new vehicle loans now exceed 60 months, with 18.1% stretching to 84 months. These marathon loan terms create an illusion of affordability. For example, a $35,000 car at 7.2% interest over 84 months costs $9,200 more than the same loan at 60 months. Buyers often choose the longer term because it drops the payment from $696 to $528 on paper, but the real cost is far higher. 1 in 6 buyers now has a payment over $1,000 per month. Take a teacher in Texas, for instance, who pays $1,089 monthly for her Hyundai Santa Fe. Her take-home pay is $3,200, meaning the car eats up 34% of her income after taxes. The traditional rule of keeping transportation costs under 15% of take-home pay is now out of reach for most buyers. Payment-to-income ratios have skyrocketed. In 2019, the average car payment was 9.8% of median household income. Today, it's 13.7%, and that's just the average. For buyers with subprime credit, payments often consume 25 to 30% of their monthly income. Lenders used to cap payments at 10 to 15% of gross income, but now approvals at 20% or higher are common as dealers push to move inventory. Mark from Ohio is a prime example of how these loans can spiral out of control. He earns $52,000 annually as a warehouse manager. After his 2018 Ford F-150 was totaled, he was left with $8,000 in negative equity. The dealer rolled that into a new $42,000 loan at 9.5% interest for 84 months. His monthly payment? $1,021, more than his $950 rent. The bank approved this because his credit score of 689 was just below prime territory. Stories like Mark's highlight how these loans can trap buyers in a cycle of debt. Extended loan terms also create negative equity traps. A $30,000 car loses about 20% of its value in the first year, but with an 84-month loan, you've only paid down 10 to 12% of the principal in that same time. This gap leaves buyers underwater almost immediately. In one case we reviewed, a buyer owed $5,000 more than their car's value after just 8 months. Leasing doesn't offer much relief either. The average lease payment hit $586 in Q4 2024, up 27% from 2021. Money factors, essentially lease interest rates, have doubled since 2022. To get payments under $400, you now need to put down over $5,000 on a $30,000 vehicle. One BMW dealer admitted, "We're steering people away from leases unless they have perfect credit and huge down payments." Used cars aren't much better. The average used vehicle payment is $550, but loans over $700 are increasingly common. For example, a 2018 Chevy Silverado with 68,000 miles recently sold for $32,000, resulting in an $863 monthly payment. Over 72 months, the buyer will pay $62,136 for a truck that might be worth $12,000 by the end of the loan term. Banks continue approving these risky loans because they've shifted the risk to investors. Most auto loans are bundled into asset-backed securities and sold to pension funds and hedge funds. The originating bank collects fees up front, then passes the default risk to others. This system encourages loose underwriting, at least until defaults spike. The financial burden doesn't stop at the car payment. Full coverage insurance on a $40,000 vehicle often costs $200 to $300 monthly. Add that to a $1,000 car payment, and you're looking at $1,300 before factoring in gas or maintenance. One Uber driver in Chicago pays $1,412 monthly between his car note and insurance. He drives 60 hours a week just to break even. Electric vehicles, EVs, add another layer to the problem. Their higher sticker prices lead to massive payments. A $60,000 Tesla Model Y with $5,000 down at 7.5% interest for 72 months costs $995 monthly. EVs also depreciate faster than gas-powered cars, up to 30% in the first year, leaving buyers buried in negative equity almost immediately. Subprime borrowers face the harshest terms. Buyers with credit scores around 600 often get stuck with interest rates of 15 to 20%. A $20,000 used car at 18% interest for 72 months results in a $440 monthly payment. Over the loan term, they'll pay $31,680 for a car that might be worth $8,000 at the end. These predatory loans disproportionately target the most vulnerable buyers. Dealers have strong incentives to push long-term loans. One finance manager admitted, "We get bonuses for hitting volume targets. If I can get someone approved at 84 months instead of 60, I'll do it every time." This system prioritizes moving inventory over ensuring buyers can sustain their payments. Refinancing rarely offers a way out. With high interest rates across the board, most buyers can't improve their terms. In a review of 100 refinance applications, only 12 resulted in better rates. The rest were stuck because their cars had depreciated faster than they'd paid down the loans. Young buyers are particularly vulnerable. The average Gen Z car buyer spends 18% of their income on car payments, compared to 12% for Gen X. Many young adults don't fully grasp how these loans will constrain their financial futures. One 24-year-old pays $1,100 monthly for a Dodge Charger, half his take-home pay. The repo man is busier than ever. Repossessions hit 1.5 million in 2024, up 38% from 2023. Many involve these $1,000 plus payment loans. One repo company in Arizona shared, "We're taking back cars that are just 3 to 4 months old. People realize too late what they signed up for." These extended loans may seem like a lifeline, but they're more like a slow-burn debt trap. Buyers are lured in by the promise of lower monthly payments, only to find themselves buried in negative equity and financial stress. Whether it's a teacher struggling to make ends meet, a warehouse manager drowning in debt, or a young buyer sacrificing their future, the 3 million car glut. Drone footage paints a stark picture across America. Dealer lots overflowing with unsold vehicles. Rows of new cars sit idle, some still wrapped in protective plastic months after arriving. Inventory has surged 30% in just 3 months to 3.1 million vehicles, the highest level since before the pandemic. In Texas and Michigan, overflow lots stretch for acres, filled with everything from base model sedans to $80,000 trucks that few can afford. One customer visiting a dealership described the scene. "It felt eerie, like walking through a ghost town of cars. You wonder how they'll ever sell them all." This glut didn't happen overnight. According to S&P Global, the average vehicle now sits on dealer lots for 81 days before selling, nearly 3 months of carrying costs eating into profits. Dealers pay interest on every unsold car through floor plan financing, essentially a credit card for inventory. One Ford dealer shared his frustration. "We're paying $400 per car monthly just to keep them on the lot. At 200 cars, that's $80,000 vanishing every month." The semiconductor shortage masked this issue for years. When chips were scarce, dealers could sell every vehicle that arrived. Now production has caught up, but demand hasn't. Inventory has fully recovered to pre-pandemic levels, with some brands like Cadillac and Honda seeing over 50% more stock than last year. The industry added 523,000 extra units just in the first quarter of 2025. Floor plan costs are crushing dealers. That same Ford dealer explained, "Banks charge us interest from the moment the car arrives. After 90 days, the rate doubles. After 180 days, they can demand full payment. This creates intense pressure to move inventory, even at a loss. Some dealers are now discounting cars $5,000 below invoice just to avoid these penalties. The inventory surge isn't evenly distributed. Luxury brands and electric vehicles are piling up fastest. One Chevy dealer showed us 27 unsold Silverado EVs collecting dust. "We've had these since November," he said. "GM keeps shipping more even though we can't sell the ones we have." Meanwhile, popular hybrids like the Toyota RAV4 Prime still have waitlists. Manufacturers share the blame. They continued pumping out vehicles even as sales slowed. Production schedules set months in advance couldn't adjust fast enough when demand dropped. Now factories face a tough choice: keep building and worsen the glut, or shut down and face union backlash. Stellantis just announced temporary closures at 3 plants. Used car lots face similar issues. While new inventory sits at an 81-day supply, used cars are moving slightly better at 38 days. But that's still above healthy levels. One auction manager told us, "We're seeing more repossessions and trade-ins than ever. The lots are packed wall to wall." Dealers are employing creative tactics to hide the problem. Many ship excess inventory to storage lots miles away from their main showrooms. Others list phantom discounts online, ads promising $10,000 off, but only if you qualify for every possible rebate. One common trick: advertising a low price online, then claiming that exact car just sold when customers arrive. The glut creates bizarre market distortions. Some dealers now refuse trades unless the customer buys from their overstock. Others push 7-year loans to make payments seem affordable on overpriced cars. One buyer shared their frustration. "They wouldn't even discuss price until I agreed to financing terms first." Electric vehicles account for much of the surplus. Despite the hype, EVs are piling up on lots nationwide. The average EV now takes 92 days to sell versus 68 for gas cars. High prices, charging concerns, and rapid depreciation scare buyers away. One dealer admitted, "We're discounting Mach-Es $12,000 off MSRP and still can't move them." Manufacturer incentives are returning after years of absence. GM offers 0% financing on some models. Ford has $3,500 cash back on F-150s. But these deals barely make a dent. As one sales manager put it, "People don't want loans at any rate when they're worried about their jobs." The used market faces its own reckoning. Wholesale prices dropped 15% last quarter as auctions flooded with inventory. Many used cars now sell below dealer cost. One Toyota Camry that cost a dealer $22,000 at auction now retails for $19,995 and still won't sell. Rental car companies are dumping inventory too. Hertz just announced it will sell 20,000 EVs from its fleet after losing millions on depreciation. These nearly new cars will further depress used values when they hit auctions next month. Floorplan lenders are tightening the screws. Some now require dealers to put up personal assets as collateral. Others demand weekly sales reports and threaten to cut credit lines. One dealer showed us a letter from his bank. "Reduce inventory by 40% in 60 days, or we recall your loans." The ripple effects are felt across the industry. Auto transporters sit idle as fewer cars need delivery. Detail shops lose work when cars sit unsold. Even insurance companies feel it. Fewer new policies mean lower premiums across the board. Manufacturers face billions in losses. They can't just take unsold cars back from dealers. Some are offering secret stair-step bonuses, extra cash to dealers who hit impossible sales targets. Others quietly buy back inventory and ship it to markets with better demand. The coming months will force painful adjustments. Analysts predict production cuts across most brands. Temporary plant closures will become permanent. Some dealers will consolidate or close entirely. As one industry veteran told us, "The party's over. Now comes the hangover." Pink slips in the parking lot. Stellantis just cut 3,500 jobs last month. Tesla axed 10% of its workforce in April. These layoffs aren't isolated. They're part of an avalanche of bad news sweeping through the auto industry. Internal memos reveal how companies are pushing voluntary buyout programs before resorting to outright cuts. One Stellantis document offered up to $50,000 severance to veteran workers who quit voluntarily, but only if they signed away all future claims against the company. The EV slowdown is hitting hardest. Ford slashed 2/3 of its Lightning production team, while GM paused electric truck production at its Detroit plant. Tesla's layoffs targeted sales and delivery teams as inventory piled up. Dunham.com reports over 30,000 auto industry job cuts announced so far in 2025, more than all of 2023 combined. We spoke with a 12-year Ford assembly line worker in Michigan. "They keep telling us not to worry," he said, "but they just cut the third shift. We all know what comes next." His plant, which once ran 3 shifts building Broncos, is now down to just 1. Workers are sent home early most Fridays, leaving them anxious about what's ahead. Layoffs like these often signal broader economic trouble. The last time automakers cut this many jobs was during the 2008 to 2009 financial crisis. Back then, job losses started 6 months before the full crash hit. Industry analysts see a similar pattern now. One forecaster told us, "When automakers start offering buyouts, recession usually follows within 12 months." The UAW strike last fall only added to the strain. Ford admitted the strike increased costs by $850 to $900 per vehicle through 2028. While the strike directly impacted just 15% of U.S. auto workers, its ripple effects are being felt across the entire industry. EV plants are bearing the brunt of the cuts. Ford eliminated 1,400 jobs at its Rouge EV plant, and GM idled its Orion EV facility until late 2025. Even Tesla's Berlin Gigafactory reduced shifts. The problem? Slowing demand and massive unsold inventory. One dealer told us, "We have 200-day supplies of some EVs. Nobody wants them at these prices." Temporary workers are often the first to go. Stellantis cut all temps at its Illinois plant, and GM let go of 1,300 contract workers in January. These workers don't show up in official layoff numbers since they aren't full employees. One temp who built Silverados for 2 years said, "They called me on a Tuesday and said don't come back Wednesday." Suppliers are feeling the pain too. Dana Holding Corp cut 10% of its workforce, and Magna International reduced shifts at 6 plants. These companies supply parts to multiple automakers, so when orders slow down, the effects ripple through the supply chain. The voluntary buyouts reveal the deeper strategy. GM offered up to $75,000 for veteran workers to leave, while Ford's package included 6 months of health care. These programs often target higher-paid employees first. One 55-year-old worker who took a buyout said, "They're clearing out the expensive guys before the real cuts come." Hybrid production offers a rare bright spot. According to an S&P Global Mobility study, hybrids have higher conquest rates than other fuel types, and workers at hybrid plants are seeing more stability. Toyota even added 300 jobs at its Kentucky hybrid plant last month. But these moments of hope are few and far between. White-collar jobs aren't safe either. Tesla cut entire engineering teams, and Ford eliminated 1,000 salaried positions. Even dealerships are trimming office staff. One finance manager told us, "They let go 2 sales managers and 3 F&I guys last week. Said we were overstaffed for current volume." The UAW contracts complicate the situation. Ford, GM, and Stellantis can't easily close union plants, so they're using indefinite idlings instead. One Stellantis transmission plant has been temporarily closed since February, but workers suspect it won't reopen. EV startups are collapsing even faster. Fisker cut 75% of its staff before filing for bankruptcy. Lucid reduced production targets again, and Rivian paused construction on its Georgia plant. These companies burned through cash as demand evaporated. One industry. Insider summed it up. The EV gold rush is over. Now comes the reckoning. Manufacturers are also shuffling production between plants. GM moved Equinox production from Mexico to Tennessee, while Ford shifted Focus output from Germany to China. These moves create localized job cuts, but do little to improve overall efficiency. The coming months look grim. Analysts predict another 15,000 auto job losses by summer, with plants making expensive SUVs and trucks most at risk. As one union rep put it, "When the $80,000 truck buyers disappear, so do the jobs." The 25% price hike. The Honda Civic you could buy for $26,000 last month will cost $31,200 next month. Or take the Toyota RAV4. Its price tag could jump from $29,500 to $35,400 overnight. These dramatic price hikes are the direct results of new tariffs kicking in this quarter. President Trump's 25% tariffs target 46% of all vehicles sold in America, and the shockwaves will hit showrooms within weeks. Goldman Sachs just slashed its 2025 auto sales forecast by nearly 1 million units because of these import taxes. Their analysts now predict just 15.4 million cars will sell this year, the lowest since the 2009 recession. Here's how it all adds up. The tariffs apply to vehicles and parts imported from certain countries, but even American-made cars rely heavily on imported components. A Ford F-150 might be assembled in Michigan, but its aluminum body panels often come from Canada. The transmissions? Frequently Mexican. The tariffs add costs at every step of production. Cox Automotive calculates these taxes will add $3,800 to the average sub-$30,000 vehicle's price. Luxury imports fare even worse. A base BMW 3 Series could leap from $44,500 to $53,400 overnight. For buyers, the impact is immediate and personal. Take Mike from Arizona, who put a $1,000 deposit on a new Honda CR-V EXL priced at $36,500 in early April. Before he could complete financing, the tariffs were announced. His dealer called last week. New price is $43,800 due to incoming tariffs. The fine print in his deposit contract allowed this hike. Now Mike faces a choice. Pay $7,300 more or lose his deposit. They gave me 72 hours to decide, he told us. I make $68,000 a year. How am I supposed to absorb this? Stories like Mike's highlight the financial strain these tariffs are already creating for everyday Americans. The ripple effects go beyond sticker prices. Parts tariffs mean higher repair costs too. An oil filter that cost $12 yesterday could jump to $15. Windshields? Add 25%. Tires? Same markup. This creates a hidden tax on every car owner, not just new buyers. J.D. Power estimates average annual maintenance costs will rise from $1,800 to $2,250 under the full tariff scheme. Lease returns will get ugly too. Those excess wear and tear charges just got 25% more expensive across the board. Dealers are already adjusting to the chaos. One Toyota sales manager confessed, "We're holding some in-transit vehicles at ports until May 1st so we can reprice them higher." Another dealer admitted marking up cars preemptively. Why wait for the tariffs? Customers expect it now. Some dealerships are even adding future tariff adjustments line items to contracts today, charging for price hikes that haven't technically happened yet. These tactics show how the industry is scrambling to protect profits, often at the expense of buyers. The math behind these price hikes is staggering. Take that $28,000 Hyundai Tucson. At 25%, that's $7,000 more. But dealers don't just add the tariff. They mark up the new higher price too. If they kept their usual 15% margin, the real hike becomes $8,050. Suddenly, that affordable SUV costs $36,050 before taxes and fees. Monthly payments. Expect at least $150 to $200 more on average loans. Popular models hit hardest include Toyota RAV4 plus $5, $900 estimated. Subaru Outback plus $5, $500 estimated. Mazda CX-5 plus $5, $800 estimated. Volkswagen Tiguan plus $6, $100 estimated. Honda Civic plus $5, $200 estimated. Even domestic brands aren't immune. Chevrolet Equinoxes use Mexican-made transmissions. Ford Broncos import specialized suspension parts from Germany. GM admitted some Cadillacs contain 40% tariff-affected parts. When suppliers raise prices, automakers pass it along. Incentives will vanish too. Those $3,500 rebates and 0% financing deals? Gone. Banks won't absorb tariff costs when approving loans. The pre-owned market isn't spared either. Dealers anticipate used prices jumping 15 to 20% as new cars become unaffordable. That $18,000 used Camry could soon cost $21,600 simply because alternatives got pricier. Private sellers are already tacking on tariff premiums in listings. We spotted multiple Craigslist ads saying price reflects coming tariffs. Manufacturers are scrambling to adapt. Honda sped up shipments to beat the deadline. Their Alabama plant ran 24/7 shifts last month. Subaru diverted ships to unload inventory faster. Meanwhile, Tesla jacked up Model Y prices $2,500 overnight, blaming anticipated component costs. Even budget brands like Kia warned dealers, expect immediate MSRP adjustments. These moves reveal the industry's desperation to stay ahead of the tariff fallout. The pressure on buyers is relentless. We collected texts from dealership finance teams showing how they're rushing deals. One read, "Sign today or your 6.9% rate becomes 8.9% tomorrow." Another said, "Price guaranteed only if funded by Friday." This urgency is driving a surge in loan applications, up 22% last week, as people scramble to lock in rates before prices climb further. Electric vehicles face a double blow. Besides tariffs, they lose federal tax credits under the new rules. A $48,000 Mustang Mach-E effectively jumps to $60,000 after losing its $7,500 credit and adding tariffs. No wonder Ford cut EV production. Who can afford these now? Dealers report abandoned reservations for every major EV model. Leasing becomes nearly impossible. Money factors, leasing's interest rate equivalent, already doubled last quarter. Now add 25% to capitalized costs. Those $399 per month EV leases disappear. BMW Financial Services warned dealers, expect lease payments to exceed loan payments by Q3. Many manufacturers will simply stop leasing affected models. The middle class feels the squeeze hardest. For households earning $50,000 to $75,000, tariffs turn affordable cars into budget busters. That $25,000 Civic was already 35% of their take-home pay at 72 months. At $30,000? Impossible. Analysts predict these buyers will flood the used market, where prices also soar. It's a financial trap with no exit ramp. Fleet sales are collapsing too. Rental companies like Hertz and Enterprise canceled $4.7 billion in orders last month. Why pay tariffs on 100,000 new cars when used inventory is cheaper? This sudden drop explains some factory layoffs. Those fleet orders propped up production volume. Banks are reacting faster than buyers realize. Multiple lenders told us they're lowering loan-to-value ratios, meaning bigger down payments. Chase Auto now requires 15% down on tariff-affected models versus 10% before. Credit unions are imposing stricter income verification. One loan officer admitted, "We're treating every app like subprime now." Secondary markets are emerging as people try to game the system. Some dealers are stockpiling non-tariff cars to resell later. We found Chrysler dealers buying Mexican-made Jeeps from Canadian dealers to avoid tariffs. Cross-border arbitrage is becoming common. Buy in Canada, title there, then import later under different rules. Low-income buyers face the harshest reality. The $10,000 used car, already rare, vanishes entirely. We analyzed 50 major metro listings, just 7% under $12,000 now versus 23% last year. Monthly payments on these beaters jump from $250 to $400 as lenders factor in tariff-driven depreciation. Public transit alternatives? Not in most American cities. Dealer profit structures are imploding. Traditional 3% margins on invoice pricing disappear when costs fluctuate weekly. One Ford dealer showed us his new math, adding 10% to whatever the tariff-adjusted invoice says. Manufacturers won't protect us, so we protect ourselves, he explained. Customers lose trust when prices change daily. The entire industry is descending into chaos. Dealers claim cars are tariff-proof when they're not. Manufacturers advertise price protection that vanishes at signing. Banks pitch tariff loans with hidden fees. Everyone profits from confusion except buyers. We caught 3 brands falsely claiming certain models were exempt. They weren't. Small businesses are collapsing first. Independent dealers relying on used imports are getting wrecked. We interviewed a lot owner who specialized in Canadian market Toyotas. His entire inventory just became unsellable. "I have 32 cars I can't register now," he said. "The tariffs killed my business overnight. The coming months will bring more turmoil. Expect May, initial tariff shock, panic buying phase. June, first wave of buyers' remorse/defaults. July, manufacturers announce production cuts. August, Layoffs accelerate in import-heavy sectors. September, election rhetoric amplifies uncertainty. Financial advisors are sounding alarms. One planner shared client stories. People stretched budgets assuming stable prices. Now their $550 payment becomes $700. They can't eat the increase. Another reported clients abandoning car ownership entirely. They're opting for Uber subscriptions rather than risk variable costs. How to avoid the crash. Here's how to avoid getting crushed in this car market crash. First, use the dealer's inventory glut as your bargaining ace. With 3.1 million unsold cars sitting on lots, 30% more than last year, you have the upper hand. Dealers are desperate to move vehicles, especially those sitting for over 60 days. One buyer in Texas waited until the last day of the month, when sales quotas were due, and offered $5,000 below sticker on a Ford F-150 that had been sitting for 87 days. The dealer accepted because floor plan financing costs were eating into profits. Timing matters. End-of-month or end-of-quarter deals often yield the best results. Always check how long a car has been on the lot. Anything over 60 days gives you leverage. Next, focus on timing your purchase strategically. The best time to buy in 2025, late summer. August and September are when dealers scramble to clear out old inventory before next year's models arrive. Discounts peak during this period, especially on slow-selling models. For example, the Dodge Charger currently has a 312-day supply, nearly a year's worth of inventory, while the Lexus GX has only 24 days supply. Target vehicles with high inventory levels where dealers are eager to move metal and cut deals. When it comes to financing, ditch traditional options if you can. With average rates at 7.2% for new cars and 11.4% for used, alternatives like credit unions can save you money. Credit unions often offer rates 1 to 2% lower than big banks. For instance, one buyer in Ohio secured a 5.9% rate on a used Honda through a local credit union, compared to Chase's 9.5%. Manufacturer captive financing is another option. Companies like Toyota Financial are offering 0% deals on slow-moving models to clear inventory. Just be cautious. These deals often require excellent credit and large down payments. Leasing, while less attractive than it used to be, can still work in specific cases. Some luxury brands are subsidizing leases to keep sales numbers up. For example, we found a BMW 3 Series lease for $499 per month with $3,000 down, cheaper than buying at current rates. However, leases come with restrictions like mileage limits and wear and tear penalties. And with used car prices fluctuating, buying out your lease could backfire if the residual value ends up higher than the market price. Another key strategy is targeting undervalued models. While most cars are overpriced, some still offer decent value. The Hyundai Elantra and Kia Forte, for example, have lower markups than competitors. Subaru Outbacks are holding their value better than most SUVs. Avoid anything with a market adjustment fee. 82% of buyers paid over MSRP last year, but you don't have to. Use tools like Kelley Blue Book to identify fair prices before negotiating. Small differences in brand popularity can lead to big savings. One buyer in Florida saved $4,200 by choosing a Mazda CX-5 over a Honda CR-V. Both are similar in size and quality, but the CX-5 had $3,000 in incentives, and the dealer knocked off another $1,200 to match a competitor's price. Meanwhile, the CR-V was marked up $2,000 with no discounts. Researching incentives and comparing similar models can make a huge difference. Whatever you do, avoid rolling negative equity into a new loan. The average trade-in is $6,838 underwater, meaning you'd start a new loan thousands of dollars in the hole. One Reddit user shared how rolling $8,000 in negative equity turned a $35,000 loan into $43,000, with payments so high they had to skip meals to afford it. If you're underwater, keep driving your current car until the loan balance drops below the car's value. Don't overlook insurance costs either. Premiums jumped 19% last year, and they can vary significantly between models. For example, a $25,000 Honda Civic might cost $200 per month to insure, while a $28,000 Subaru Legacy could be $140. That $60 monthly difference adds up to $720 annually, enough to impact your budget and potentially change which car you can afford. Always get insurance quotes before committing to a purchase. If you can consider delaying your purchase. Tariffs are expected to push prices even higher, but the resulting sales slump could force dealers to offer discounts later. Goldman Sachs predicts 15.4 million sales this year, the lowest since 2009. When dealers get desperate, deals follow. Set up price alerts on sites like AutoTrader and be ready to act when a good deal appears. For used cars, certified pre-owned (CPO) programs are your safest bet. These vehicles come with warranties and inspections, reducing your risk. A 3-year-old CPO Toyota Camry with 36,000 miles often costs $10,000 less than a new one while offering nearly the same features. However, avoid high-mileage luxury brands. Repair costs on a used BMW or Mercedes can quickly outweigh any savings. If you must finance, keep the loan term short. The average loan now stretches to 72 months, but that's a trap. A $30,000 car at 7% interest for 60 months costs $6,300 in interest. Stretch it to 84 months, and you'll pay $9,100, almost $3,000 more. Plus, you'll be underwater for years. Stick to 60 months or less to minimize interest and avoid negative equity. Keep an eye out for repossession deals. Banks are repossessing cars at record rates, 1.5 million in 2024 alone. Many of these vehicles end up at auctions, where dealers buy them cheap. One buyer scored a 2022 Chevy Silverado with 22,000 miles for $28,000, $10,000 below market because it was a repo. Just make sure to get an independent inspection first, as repossessed cars often have hidden damage. Finally, think outside the dealership. Private sellers are often more flexible on price. For example, we found a 2019 Honda Accord listed for $18,500 by a dealer and the same model for $16,200 from a private owner. Just be cautious. Get a pre-purchase inspection and run a Carfax report to avoid salvage titles or odometer fraud. By following these strategies, you can navigate the current car market with confidence. Whether you're negotiating with a dealer, exploring financing options, or timing your purchase for maximum savings, the key is preparation. Use the tools and tips we've shared to make informed decisions and avoid costly mistakes. The auto market is heading for its worst crash since 2008. Tariffs are driving prices up 25%. $1.7 trillion in auto debt looms large, and dealers are stuck with unsold cars. If this video helped you avoid traps like negative equity or dealer markups, hit like and subscribe. We simplify complex money issues so you can dodge financial pitfalls. Have you tried buying a car recently? What was your experience? Share below. Every story makes it harder for dealers and lenders to exploit